Current live trading data for Rivian Automotive Inc., ticker symbol RIVN, shows the stock trading at $18.89 per share. That is a massive intraday surge of plus $2.46, representing a 14.95% gain on the session so far. The market is currently open and active, and what we are witnessing right now on the tape is significantly higher volume than the average daily turnover, indicating that this move is being driven by high-conviction institutional buying rather than just retail speculation. When you look at a move of 15% in a single trading session for a company capitalized at over $20 billion, your immediate expectation is probably that they just reported a surprise profit or announced a buyout. That is the standard expectation in financial markets. Price action this violent usually follows a binary financial event. But the reality here is far more nuanced and, frankly, far more interesting for anyone holding the stock long term. The catalyst driving this price action isn't a takeover bid. It is a fundamental shift in how the market is valuing Rivian's intellectual property. For the longest time, the bearish expectation was that Rivian was simply a hardware manufacturer, a company bending metal, buying batteries, and struggling to squeeze out a margin on heavy trucks. That is a capital-intensive, low-margin business model that Wall Street generally hates. The reality we are seeing unfold today, however, is the realization that Rivian is transitioning into a software and architecture licensor, essentially pivoting to become the platform on which other automakers might build their future fleets. This disconnect between the struggling truck maker narrative and the critical tech infrastructure reality is what is fueling this buying frenzy. Let's unpack exactly what is happening today, because if you're just looking at the headline numbers, you're missing the story. The surge we are seeing right now is a direct, delayed reaction and repricing following the company's Autonomy and AI Day and the subsequent Analyst upgrades that are rolling in, specifically the aggressive target hike we saw from Needham this morning. The market is finally digesting the fact that Rivian isn't just buying off-the-shelf parts, they are designing their own silicon. This is where the comparison to Tesla stock becomes unavoidable but necessary. For years, the premium valuation afforded to Elon Musk's company was largely due to their vertical integration. They didn't rely on suppliers for their most critical software and chip architecture. Rivian is now proving it is the only other pure-play EV maker in the United States following that exact same playbook, and the market is paying up for it today. When we talk about the proprietary tech that was showcased, we have to talk about the new Rivian Autonomy Processor, or RAP1. This is a big deal. Most auto manufacturers are beholden to third-party chip suppliers, which puts them at the mercy of supply chains and generic roadmaps. By bringing chip design in-house, Rivian is doing what Apple stock did over a decade ago with the A-series chips, taking control of their own destiny to optimize performance and cost. The RAP1 chip, paired with their new camera and radar suite, allows Rivian to offer what they are calling Autonomy Plus, a subscription-based self-driving feature set priced at either $2,500 upfront or roughly $50 a month. This is the holy grail for automotive investors: recurring software revenue. It transforms a car company from a business that sells you a product once every 7 years into a business that bills you every single month. That revenue is high margin, sticky, and drastically improves the long-term cash flow profile of the company. However, we need to ground this excitement in the cold, hard numbers of the present. While the stock is flying high today at nearly $19, we cannot ignore the broader context of where we have been. If you zoom out on your Fidelity trading platform or whatever interface you use, you'll see that this stock has had a brutal journey over the last few years. The climb back to the $20 region has been arduous. The skeptics, and there are many, will point out out that producing chips and writing software is expensive, and Rivian is still burning cash. This is where the tension lies. The bulls see a technology powerhouse in the making. The bears see a cash furnace. But today, the bulls are clearly in control. The volume we are seeing suggests that a lot of short sellers who were betting on Rivian's insolvency are being forced to cover their positions, adding fuel to this fire. If you are an individual investor trying to navigate this volatility, you might be looking at this through Schwab Intelligent Portfolios, or perhaps checking your Robinhood app, wondering if it's too late to buy or if this is the start of a breakout. It is crucial to understand the mechanism behind today's move. It isn't just retail enthusiasm. When you see a 15% candle on a mid-cap stock, that's often institutional reallocation. Fund managers who were underweight or had zero exposure to Rivian are looking at the Volkswagen Partnership updates and the AI roadmap and deciding they can no longer ignore it. Speaking of Robinhood stock trading, the retail sentiment on those social-heavy platforms has shifted dramatically in the last 48 hours. Where there was once fear about bankruptcy, there is now FOMO, fear of missing out, regarding the R2 launch. Let's pivot to that Volkswagen deal because it's the safety net that allows this high wire act to continue. The investment from VW, totaling up to $5.8 billion, effectively de-risks the balance sheet through the launch of the R2 platform in 2026. This is the reality that is crushing the bearish expectation. The bear case for Rivian was that they would run out of money before they could achieve scale. The VW capital injection, which is tied to the joint venture on electrical architecture, basically takes bankruptcy off the table for the next 24 months. That's a lifetime in the stock market. If you're using Fidelity Wealth Management Services or consulting with an advisor, they would likely tell you that the removal of immediate liquidity risk forces a repricing of the equity. That is what $18.89 represents, a company that has been granted the runway to execute. But let's not get carried away with blind optimism. We need to analyze the business as it stands today, December 12, 2025. Rivian is still losing money on every vehicle it sells, though that loss is narrowing. The Q3 financial results we saw recently showed a 78% year-over-year revenue increase, which is impressive, but the company is still in the valley of death between their first niche products, the R1T and R1S, and their mass market product, the R2. The R1 vehicles are fantastic. Critics and owners love them, but they are expensive luxury items. The R2, which is slated for the first half of 2026 with a starting price around $45,000, is the product that needs to succeed. If the R2 is delayed, or if the margins aren't there, all this technology talk won't matter. This is a great moment to pause and ask yourself a question about your own conviction. Comment below how many shares of Rivian you currently hold, or if you are waiting for a pullback to enter. It's always fascinating to see where the average entry price is for viewers of this channel, especially after a massive green day like today. Continuing with the analysis, we have to look at the competitive landscape. You have Nvidia stock powering the AI ambitions of almost every other automaker, and then you have Rivian saying, no, we can do it better ourselves. It's a bold, arrogant, and potentially brilliant move. If they pull it off, they command the full stack. If they fail, they spent hundreds of millions of dollars reinventing the wheel when they should have been focusing on manufacturing efficiency. This is the classic innovator's dilemma. But the partnership with Volkswagen suggests that the German auto giant believes Rivian's tech is superior to what they could build themselves or buy from others. Remember, Volkswagen has struggled immensely with software. For them to invest nearly $6 billion into Rivian is essentially an admission that Rivian's zonal architecture and software stack are world-class. For those of you utilizing online investment platforms or looking for investment help, it is important to distinguish between a trade and an investment here. A trade is buying RIVN today because it's breaking out above resistance. An investment is buying RIVN because you believe in 2030 they will be one of the top 3 dominant EV players in the Western world. If you are into self-investing and use tools like interactive brokers trades, you might have noticed the implied volatility on RIVN options has been sky high. That tells us the market was expecting a big move, and now we have it. The question is, does it hold? The technicals on the chart are screaming breakout. We have cleared the significant resistance levels around $16 and $17. The next major psychological hurdle is $20. If the stock can close above $20 in the coming days, it opens the door to a much larger retracement of the losses from 2022 and 2024. However, if this is just a short squeeze pop that fades, we could see a retest of the $15 level. This is why using Fidelity brokerage tools or the SoFi trading platform to set